So you can, if you're missing something, don't worry about that. The my camera has a life of its own these days. That it you can't turn it in. You turn everything in up until Monday, May 6th, without penalty. So somebody asked me in my passing the class or whatever. Well, no one's flunking until you don't turn it in on the 6th, and so you can always turn anything in that is missing. So don't think that just because the time frame is gone or whatever that you can't turn it in. Okay, so let's go ahead and get started on 16 and 17. All right, 17. No, scratch 16. Under the audit procedures. So this is kind of wrapping up the audit. All right, so you've done all your testing. You've done, I got you're probably forming your opinion already on what this is going to be, but you're wrapping up. You got all your testing done. You got most of your stuff is completed, and you're going to be leaving the place. The management representation letter is the last thing you get on the way out the door. Okay, so this is done the last day of the audit. Management representation letter. And here's the management representation letter is. All these things that should have been done, that should be included in the audit. I don't know why. I don't know. All these things that should be done in the audit, you put those into a letter. And management has to sign the letter. And by management, we need the chief financial officer and the chief executive officer. They sign off on this thing. And these are all things that should have been done, in the audit. Everything should be complete. Everything should, all the material misstatements should be corrected, and there shouldn't be any material misstatements in the financial statements and all this kind of stuff. It's a big laundry list, basically. Now, it isn't evidence of itself. In other words, and you can't use it to substitute for audit procedures. However, what it does is it gets management to sign off on these things that they've told you and anything that you've relied upon during the audit. And the problem is what happens if they don't sign off on it. So anyway, this is, and if you look through here, I'm not going to go through each of those. But you kind of look through it. That management's responsible for the financial statements, basically. So management's, they're saying they're responsible for them. That they made all the financial records to the auditors, board of director minutes, management has all these things that they should have had. There are no unrecorded transactions. All liabilities have been disclosed. Blah, 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 going through all the stuff. So these are all things that they should have been done during the audit, and the management's responsibility for all of them. So they have to sign off on this thing. Now, again, this does not replace audit procedures, but it's management's acknowledgement of taking responsibility for the audit and for the financial statements, and that they have done their part of the job as far as providing you with all the stuff you need for the audit. Okay, so the question is, what if the chief executive officer, must both sign the audit letter, management letter, and what if they don't? The CFO refused to sign and states that I was only hired on October 10th of this year, I'm not responsible for the entire year. So the question is, what do you do? Anyone? Yep. Disclaimer of an opinion. Yeah. If they don't sign the audit, it means that there might be something more that they're not telling you. Now, it doesn't. You say, why don't you give them an adverse opinion? You don't really know if there's anything wrong. You haven't come across any dollar amounts of anything wrong. In an adverse opinion, you need to, this is for known dollar amounts. And them not signing it doesn't really tell you that. But it raises that suspicion that maybe there's a reason why they're not signing it. Okay, subsequent events. Type 1. Are events that exist at the balance sheet date? And usually the year end is 12/31, not always, but. So these is information on things that were already on the books, that they existed, and now you have more information. Subsequent type 2 events. These are, copy that. Items that did not exist. Okay, now usually, okay, so let's go back to type 1. This is usually for more information. More information about an existing item. Okay. And let's separate that out. These are for new items. New items that are significant to the financial statements. These are usually for big things. These are big things. Okay. All right. Problem. First one, the client has a year on the date of the audit report is February 24th, 2022. The release date is March 1st, 2022. Okay. The client merged with a large competitor on January 22nd. Okay. Is this a type 1, a type 2, or not a subsequent event? Yep. Yeah, the type 2. And here you say, okay, well, why, wait a minute. This didn't happen during the year. This didn't happen in 2021. This happened in, right? This happened in 2022. Why are we worried about this? It's a completely different year. Well, notice those financial statements. One of the things about financial statements, why do we release financial statements? Part of it is to report on what happened in the past, but also people try to make predictions about what happens in the future. They have a trend line and sales are going up by 5% a year, or whatever it is. Notice that goes out the window when you have a merger, that the company might be twice as big as it was before. You're telling the reader, look, all this stuff that we had, all this is for a much smaller company, these last financial statements. Now it's going to be a completely different thing. It's a big company now, it's a larger company, maybe twice as big or whatever. So you're telling it reflects on the financial statements. Well, the financial statements themselves don't change. You need to report that. You need to let the reader know that, look, it's not going to be like this next year. Yes, this is what happened last year, but coming in the future, this is not going to look like this. So that's what. Type 2 subsequent event is it's something major, and it's basically, it reflects on the financial statements, and that going into the future, it may have an impact on the financial statements, plus or minus or whatever. Okay, client had a lawsuit that had an estimated loss of $40,000. So they got this lawsuit. They estimate the loss at $40,000. They book it, and February 21st, it was settled for $36,000. So what is this? Yep, good. This is a type 1. We now have more information. We had the lawsuit existed at the end of the year. They have it on the books for $40,000. Now it's settled for $36,000. There's nothing wrong with the estimate before, but now we have more information. It could be a more exact amount to put on the book. So this would be a type 1. We got more information on it, and even though the information came from the following year, it has an impact on financial statements for the current year. It's a better number, we'll put it that way. Okay, the client ended a union strike agreement on February 15th. All right, I'm going to take this one because this one is a little bit tricky. This is actually not a subsequent event. And an obvious question is, why not? This union strike, it may be important to the company and whatever. This is normal business. If you have a union, you're going to have union strikes. A lot of times they'll happen every 2 years, 3 years, whatever. Part of having a union is that you'll have strikes. For normal things, we don't do subsequent events because that's part of the business. It's just part of the business that if they have a union, they're going to have union every now and then they have strikes. Just the way it goes. And same thing for number 4, client introduce a new product. Same thing, not a subsequent event. They introduce new products every year. It could revolutionize the industry. They say that about every product. So normal things we don't look into. We don't look to as subsequent events, and we don't need to do anything with them. These first 2 must be disclosed. Usually they're in the footnotes. And same thing here. This one you'd probably put in it was that this was settled on February 22nd. You put that right in the footnotes. The update, but yeah, it's only for unusual things. Okay. You got extra ones on here or something? Do you guys have this on yours? You must. You do. Okay. Oh, I know what this is for. This is for the take this out. This is what they call a dual dating problem. Take that out. Okay, date of the audit report. The date of the audit report is the last day of field work. So it's the last day that you're actually collecting the information. Just say evidence. So this is the last day that you will be collecting evidence. And generally speaking, this is the last day that you are on the hook for finding things. And the general rule is auditors are not responsible for items that occur after this date. Okay, so they're supposed to be actively looking for stuff. So day of the audit report, I'm just going to make up a date. Let's say February 5th, 2024. Just made that up. So this will be the date on the audit report will be that. So they'll be required to look for stuff up until the 5th. Something that happens on February 6th, they're not responsible for. Audit release date. The date the audit report is issued to the public, or to whoever has access to it. Let's just say issued, because it might, if it's a privately held company, they don't issue them to the public. So the date the audit report is issued. Now, here's where it gets a little bit quirky, and that is the auditors are required to passively look for information between the date of the audit report and the date of the in the report release date. Give me 1 second, I'll clean this up. Okay, so let's say the report release date is, it's gonna be after this, so maybe a week after, they'll get all their information, they'll go back and they'll talk it over, and maybe a week later, so what, 2/5, let's say 2/12, like a week later, maybe they issue that report. Okay, so the query are required to passively look. In other words, something that comes to their attention. Between the date of the audit report, in this case, it would be and the report release date, which in this case was 2/12. The examples I gave anyways. So if something happens and they're made aware of it, if they are aware of it, they're responsible for it between, keep doing that. I don't want to do this. Why is it being so helpful? I hate helpful things. I don't forget, I'll just do the whole thing. All right. So between the 5th and the 12th, they are passively looking. Sorry, I just sneezed. Okay, so between those dates, they're passively looking. So if something happens that comes to their attention, then they're supposed to deal with it. But it's between the date of the audit report and the release date. It's kind of that funny in between time. Between when they put out the audit report and the last day of field work. So generally speaking, they're not on the hook for anything after the last day of field work. However, if something comes to their attention, then they're required to act upon it if the report has not been released yet. Now, anything happening after the release date, they're absolutely off the hook for. They don't have anything after the 12th. So if something happens on the 13th, that is not their responsibility. You have to finish the audit at some point, right? Okay, so yeah, so between those 2 days, I had a friend they were turning in an audit report. They worked for a CPA firm, and they were literally going the day it was issued. They were taking it to the client to present it to them so that they could issue it. And in the car, one of the managers sitting in the back seat of the car and says, "We gotta go back. We turn around. We gotta go back to the office." And they had bought in some. They had a merger. While they were driving to the place to give them the audit report, there was a merger. They had to turn the car around, and go back and see what it was all about. It turned out it was a fairly small merger, and they didn't have to do anything with it. But it came to their attention literally on the way to drop off the audit report. So, okay. All right. Conflicts between the audit report and other material released in the client's annual report. I have an annual report here or not? I can't remember. I know where I have it. Where's my permanent file? Okay, here's a Ford. This is a 10K. This is similar to an audit report or annual report. This is what companies file with their financial statements. And this is a form of the SEC. Sometimes they use these for their annual reports. They'll issue to the public. Sometimes they'll clean them up a little, issue to the public. But anyway, there's tons of information on this thing that they're required to give. About halfway down, you'll find the financial statements. So we're about halfway through this document. What page are we on? I get page numbers? Come on, where's the page numbers? Well, which are the page numbers? Anyway, this is probably I don't know. This probably is. Oh, we're at page 113 out of 235. So the financial statements are going to be right in the middle of these reports, and so here's the problem though. So either whether it's a 10K or a annual report, right in the middle are the financial statements of this document. They usually have an annual report will usually have between say 80 and 120 pages, and they'll have a section with 5 or 6 pages that'll have the financial statements, and your audit opinion will be in there too. Your audit report with an opinion will be in there too. So you got these like 6 pages in, but there's all this other information in there. And 10K reports can be anywhere from a couple hundred pages to I've seen them over 1,000. So anyway, what happens if the information that they have in that 10K or the annual report doesn't match what's on the financial statements? So for instance, let's say that the sales were $930 million, and you're reading through their annual report and it says the sales were $980 million, and they weren't. They're $930 million. What happens if there's a conflict between, now you're only writing your audit report on those financial statements. However, it's in a document that's claiming something completely different. or it's materially misstated or whatever in the document, not in the financial statements. The financial statements are okay, but it's put somewhere place in that all that material that doesn't match up. So that's actually can be a problem, because they'll be claiming something that isn't true, along with those things that are accurate. Sorry, I'm having a sneezing fit right now. Okay, so what happens if there's a conflict between the financial statements and the material released with the client's in the client's annual report? So financial statements say one thing, and let me give you an example. All right, so suppose they have this situation where they have a different amount. The financial statements, this is what we do our audit on. These are what's audited. So they have one number, and there's a different one, a misleading one, in the annual report. So this would be misleading. All right. So the question is, what do you do with that? You have actually three options for this. So here's your three options. Option one. Withhold the audit report until it is corrected. Two, include the misleading information in the audit report. So in the audit report, you'll say, by the way, the amount given in the annual report is not correct. And the third one, which is probably the most severe, would be withdraw from the audit and don't issue an audit report. So these are the three ones. My guess is that most people would probably, opt for one or two. But you want to let the public know, though, that this is not, these two would let the public know that the information in the audit in the annual report is misleading. Okay, question on that? All right, chapter 17. This is going to be a little bit of review. Not all of it, but some of it's going to be a little bit of review. And then it goes into the audit reports, which we covered somewhat, at least in I think it was chapter 2. Okay, so we have two sets of rules, as you guys all know. We have non-issuers. We have people that are privately held, and they will get an audit on the financial statements, and that is an audit report with an opinion. If they're publicly traded, they have an additional audit. I think I talked about this, but I probably didn't emphasize it. I think, well, it goes along with the internal control chapter we discovered. They're going to do an audit on the financial statements like they did here. So this will be these will be similar. But they're also going to have to do an audit on the internal controls. And I'm going to throw one more wacky thing in here that the audit reports for the financial statements and the internal controls may be combined. This used to be extremely common, and now I think it's a little less common. So nowadays, a lot of times you'll see both of these as two separate audits with their audit reports. In the past, they used to combine them into one. Most companies did this. I think just because people were used to seeing one audit report. But nowadays, they usually separate them out. But they can be combined into one audit report. It'll have an audit report. It'll have two different opinions. They'll have an opinion on the financial statements and an opinion on the internal controls. Okay. So as we go through these two audit reports, keep this in mind. We're going to kind of compare and contrast the non-issuers versus the issuers in the audit reports. But so the non-issuers, they just do a financial statement audit. This is what we're going to do first. Look at this audit report. And then the issuers, they will have their own audit report. It's very similar, a few different things in there, but yeah. So we'll go through those. Okay, so this is the independent auditor's report, and this is private, and this is only for these are the only rules that they have to follow if you are a non-issuer. And these are usually the state laws will require people to use these reports. First, always. Let's just say always. They always do that. So this is one of those weird things that if you're going to keep your, the state licenses you, and they have rules, obviously, to go with the license, just like they have rules for driving a car. So they have these rules, and if you break them, you can lose your license. And one of them is that you must use this report. They'll say, this is a report you have to use. So, we always talk about don't plagiarize things. Well, in in this profession, when it comes to writing an audit report, you must plagiarize it or else you'd be in trouble. So you have to use this audit report. You can only use this audit report if you're a CPA, but so this is a report that you must use, and is by the state. The state will require this. Okay, and you write this report not to management, but to those people outside the company. Management made the financial statements; they don't need to have a report. Let's say not management. So these are people outside the company, shareholders, board of directors of ABC. Some may be inside, but you're writing to those that are outside the company. But management, you don't write to them. They already did it. They already made the financial statements. Okay. And we start out with the opinion. This is different than in my day. They used to go right to the opinion was the last thing, but people would always jump to the opinion. So they said, okay, let's go ahead and put it first because that's what people care about. And down here's your opinion. This kind of shows what you audited up here, but this down here says in our opinion, and they talk about kind of vague terms, present fairly. We don't, in all material respects, we don't say in all respects, but material respects. Financial position, I think I've gone through this before. This is the balance sheet. Not bad to do it again. Let's clean that up. Okay, so financial position is the same thing as balance sheet. Result is operations. This is usually net income. You say, well, why do they say results of operations and not net income? I don't know. I should say income statement. Oops. And cash flows are just cash flows. Thank you, cash flows, for not being different. Okay, and we tell what accounting principles we used. And we use those in the United States of America. Could be international standards too, but we use the US ones. So this is our GAAP. Accepted auditing principles. All right. Question on that? Here's something that's kind of quirky, and that is that the generally accepted accounting principles, international standards are generally accepted accounting principles too. They're just generally accepted in different countries. So sometimes when you hear people talk about GAAP, oftentimes they're talking about US GAAP, but actually generally accepted accounting principles could be international standards too, because those are also generally accepted accounting principles. Okay. Based for our opinion, we conducted our auditing standards. Now, this is different than the accounting standards. So here we have our accounting principles up here. Here we have our auditing standards. And those are generally accepted auditing standards in the United States of America. So the opinion is going to have your GAAP. The basis for your opinion is going to have your GAS, your auditing standards. So these are generally accepted auditing standards. I should write that. Create room. I'll make room. Okay, so gap is generally accepted. So that gap is generally accepted accounting principles. Gas is so the auditing standards are going to be your basis for an opinion. The accounting standards are going to be in your opinion. And that's a really easy CPA question for them to throw out at you. You know, where do you find the generally accepted accounting principles in the audit report? Where do you find the generally accepted auditing standards in the audit report? Okay. It goes through kind of you can read through this. And it's all important. Probably the most important thing we have is here, and that is, we believe our audit evidence that we have obtained is sufficient and appropriate to provide a basis for our opinion. So the opinion is based solely on your evidence, nothing else. You know, you can't say the promises of this person or that person or the bank or anything else. It's our evidence is the only thing we're basing our opinion on. Responsibility, manager's responsibility. Manager responsible for the financial statements. And maintenance of internal control. So management's responsible for the financial statements and their internal controls. And we talk about due to fraud or error. This isn't really new. Back in my day, we just said misstatements, but now they break it up into fraud or error because they are kind of two different things, obviously. It was kind of a funny one. General Motors, on their statement of cash flows, had an error. This is in 2009. You can look it up if you want. 2009, General Motors had an error on their statement of cash flows. You go, oh, well, the auditors probably found it. A graduate class studying General Motors as a case study found that they had missed, they misstated their statement of cash flows by putting something in. They put something in operations that should have been in financing, but it was found literally by a graduate class at a university doing it as a case study. So does do errors happen? Yeah, I mean, General Motors. I mean, they've been around for 100 years, and so it does happen. Yeah, that didn't go over well, by the way, with the Securities and Exchange Commission. They were kind of hot about that. All right. Okay. Let's kind of skip on a little bit here. We talked about this before. We get reasonable assurance about where the financial statements are free of material misstatement. We never say of all misstatements. Whether due to fraud and error, again, back in my day, it was just misstatements. Now it's fraud or error. We get reasonable assurance, while high level assurance is not accurate, but therefore we guarantee. Okay, it goes into a little bit talking about what it is. All right. And one of the things that we always talk about too is that we talk about professional judgment. And this is why auditing is difficult, is professional judgment. It's difficult to learn judgment. If you want to come up with well, like us doing these statistics. Yeah, we get the numbers, but what do they mean? Is this materially misstated? Okay, it's their financial, their whatever this account is overstated by $74,000 or whatever. Is that material? That's a judgment. That's harder to teach than coming up with the 74,000. And by the way, in auditing, one of the things that when you recognize you're in a judgment position, is this material or not? Generally, you go to your supervisors, and ask them. Don't try to make that decision on your own. And I say that because, especially for public auditing, if you put something in the audit report that it's material, someone has to clear that. So if nothing gets a senior mad, like someone putting something in that's saying it's material when it's not, and then they got to go back and clear it out and put in all this verbiage about how it's not material. So I would say if you do find something, don't do anything with it until you talk to your supervisor. Let them make that decision, and you'll learn from that decision. Okay, is this material or not? And I think I told you guys this, that I found a $100,000 error. Navister has an insurance company. I found this $100,000 error that they had in cash that should have been in investing, and I was all excited about it, and I showed it to the Deloitte and Touche guy that I was working with. He literally was so dismissive. He was like, "Oh, all right, thanks." It didn't make any difference to him. It was $100,000. You're talking about, hundreds of millions of dollars in this place. He didn't care. My supervisor did, though. My internal, he was happy about it, but we found it. But the external, they didn't care. Okay. Okay, so this is for the AICPA. We obtain an understanding of internal control. But now, no, this is where it can be a little bit different than in but not for the purpose of expressing an opinion. So this is where they're really distinguishing themselves from the publicly traded ones. We're saying, look, we're not going to give you an opinion on this internal control. This is we're non-public. This is a non-public company. We're not going to give it an audit opinion on internal control. So we do look at the internal controls, but not to give an opinion. Okay. Okay. Let's go through the newer thing on here. Is this key audit matters, CAMs. And CAMs are significant matters communicated to those in charge of the government, such as the audit committee. Okay, so these are things that are significant. That are communicated. They may not be material, but they are significant, and they were communicated to those in charge of governments. And so these are things that can be put in the audit. It can be a perfectly clean audit, but you'll have these matters that were communicated with those in charge of government. They may or may not have these. Some require them, some don't. It just depends on your client. And your client may have a bank or something that they're trying to get this audit for, and the bank may require it. So they say, we want to know what the key audit matters are. We want to know what stuff the auditors came up with that needed additional information, or someone to sign off on, or whatever. So they may ask for those key audit matters, but they're not required to. Okay, let's stop here and let's say be back at 311. Ah, okay. Okay, a couple of the key differences. You notice that the clean standard report for PCOB is called an unqualified, which might sound kind of funny. Um, hey, it might sound kind of funny, but unqualified means that there's no qualifications on it. A qualification would be, for instance, this toy is nice, but it's not blue. Not blue is a qualification. Maybe blue toys or whatever. But we're saying unqualified. We mean there's no kind of exception to what we're saying. We're saying everything's fine, nothing else, no qualifications on it. Okay. Report of the registered. You have to be registered with the PCAOB. So we have registered public accounting firm, not just a plain old public accounting firm. Opinion comes first, pretty much the same as the other, not too much difference. Here it gets it's a little bit different in the wording. Notice that they both are pronounced CAMs, right? Key audit matter, CAM with a K, and critical audit matters, CAMs with a C. And these are things that are important to the audit that we communicated to the audit committee, same as the other one is the AICPA. But they are ones that are basically the same thing. And they're usually something that is challenging, subjective, or complex. All right, so a lot of times these are things that are, it's not so easy. I'll tell you one that they had. I'm sure you guys know all these companies. All these companies are doing streaming services. Like every I don't know. Every company has a streaming service. There's like a million of them. And for a while, these are like the really hot things. It's like, oh boy, you're just making money hand over fist. Well, at some point, you get so many of them, and people start dropping off, and so it's very hard to come up with what's the value of it. We know that everyone's doing it. We know they're sinking billions of dollars into it, but what does that mean? What it's very challenging. It's subjective. Well, is just because everyone's doing it doesn't mean it's profitable. Complex, yeah. I mean, it's you're dealing with markets that are expanding, and all this other stuff that's going on. So, and doing with consumers. So, it's really hard to make a qualification. How much that is. What are those valued at? And by the way, they wrote down recently, the streaming services, a lot of them have written down a lot of stuff because, it used to be we're going to get so many people, but you have dozens and hundreds of these streaming services, and it's very difficult to do. Okay, and here's some, you can look through here. These are some of the things, critical audit matters, examples. If you're taking a CPA exam, you're definitely going to want to go through these because they might pull these out and say whether these are CAMs or not. And basically, what happens when you write a CAM? You have to do the following. Oops. Identify it. What was the consideration that you're talking about? Reference the financial statement accounts that it applies to, and then talk about how you came up with your decision. So you say what it was, what you were considering that was difficult for it, what accounts did it effect. And number 4 is basically talking about how you resolve number 2. Consideration, for instance, streaming services, the valuation of the streaming services may be difficult. And how did you come up with how did you address it? And so those are all things that you could have in there. But basically identify it, what was the problem, what accounts, and how did you resolve the problem is all in there. Another thing is kind of wacky. You have to tell how long you've been the auditor for the company. So, some of these auditors go back tens of years, if not, I've seen ones that are over 100 years. Okay. Unmodified opinions, aka unqualified. That's the PCOB one. Clean or standard opinion. All the same thing. A non-public one has all the following except standard report has everything except it does not have a report on internal controls. So non-public does not have an internal control. Standard report for the publicly issued one, issuers. All the following except it does not have the AICPA standards. I didn't cover that. You know what? I should cover that. I gotta go back up. Should be in here. Yeah, we don't say standards of the AICPA. We say in accordance with the standards of the PCAOB. So this is for the publicly traded company. They have their own standards. They don't use the AICPA standards, although they are very similar. They used to be identical, but now they're not. So they don't reference the AICPA standards. Okay, emphasis of a matter. Emphasis of a matter is when you say emphasis of a matter, these are something that's already reported, already disclosed. So emphasis of a matter. This is a paragraph you put on the end of a opinion, and it's for something that is already disclosed. So it's something that has already been talked about. And so going concern, we talked about this before. Going concern is when a company's going bankrupt. You guys remember that way back when? A going concern is when a company's going bankrupt. Or possibly going bankrupt. It's already reported. It'll be in the footnotes. This is not the answer. I'm just mentioning that the client will have to put it in their footnotes, their financial statement. So this is why it's an emphasis of a matter. This is the one that's not right. It's not within 1 year. It's at least 1 year. Oops. So it's not within 1 year. We used to, this is the old terminology, within 1 year is, it's gonna say at least 1 year. It could be out 2 years, 3 years, whatever. But this, the time frame is within 1 year. This is not a characteristic of it. The characteristic of it is is at least 1 year and could be out more. International standards are 2 years. Okay, so it's disclosed, the client must disclose it in the footnotes. This is one of those awkward situations where the client has to sit down and say, we might go bankrupt in the next year. Yeah, usually the auditors tell them they have to put that in. Okay. An emphasis of matter that is issued by the United States that has which of the following characteristics? Okay, accounting principle is not consistently applied. This happens a lot. Sounds funny, but it happens a lot, and it's. I'll tell you why it happens a lot. Whenever a new accounting rule comes out, you'll get that a accounting principle is not consistently applied. Why? Last year they didn't have the new accounting rule. This year they do. So whenever a new accounting rule comes out, you're going to get one of these GAAP not consistently applied, and they're required to comply with the new rule, right? So these are very common. No one really cares too much about them as far as the client's not going to get upset about this because a new accounting rule comes out, you change the new accounting rule. It can also be that they go from one accounting standard to another that are both acceptable. So for instance, international standards don't allow for LIFO inventory, last in, first out. They don't like it. You can't use it for international standards. If you're a US company and you're trying to get it listed on foreign stock exchanges and things like that, you may switch from that last in, first out because they're not going to let you list if you're in violation of their accounting rules. So say, okay, we're going to go to FIFO or average cost or something not LIFO. Switch from one accepted accounting rule to another. Nothing wrong with doing that, but you're going to put it in the audit report. By the way, we switched from LIFO to FIFO. You're going to put it in the audit report. You're going to say what the difference is. Our inventory is now, instead of being 43 million, it's now 41 million or whatever it is. Okay. Which one of these is this one? It's used even if it's shown that it's preferable. Oftentimes it is preferable. It's a new rule or whatever. It's you still put it in. It is not a change in estimate. So these are what it's not. A change in estimate is not a change in accounting rule. It is not an acceptable accounting rule. It's an acceptable accounting rule is a misstatement. It has to be GAAP. But if they use an unacceptable accounting rule, we don't give them one of these. They get a bad report or one of the modified reports. And if it's not material, we don't report on things that are not material. So if they change their how they use the staplers, the staples for their staplers from LIFO to FIFO, and who cares? It's immaterial. So things that are immaterial, we don't report on. So, but we do give this out even if it is justified, and usually it is. And if it's not justified, then you have a problem. But Yeah. Okay, we've talked about these already. This is kind of a refresher. These two. All right. These last ones are going to be just refreshers. We've talked about this before. Qualified opinion. Qualified opinion is when there is a material misstatement. I think it's in chapter 2. That is not pervasive. Is it PU or PR? I don't know. PU. I don't know. No, I had it right the first time. Stupid Mark. All right. Treatment statement is not pervasive. Overall, the financial statements are fairly presented. And it's not pervasive. Usually only one or two accounts. So that's a qualified opinion. Qualified is a material misstatement, but it is not pervasive. In order, all the financial statements are fairly presented, and this is sometimes called an except for opinion, often called that. And it's called an except for opinion because it says everything's okay except for this is whatever the bad thing is. Adverse opinion, the worst opinion. And these are when they're not GAAP. Material misstatement that is pervasive. Financial statements cannot be relied upon. So this is the worst opinion, the adverse opinion. Is pervasive, goes throughout the financial statements, usually affects income, balance sheet and all that. And you can't rely on the financial statements. Look, you can't rely on anything on here. These are not reliable. Disclaimer of an opinion. This is given when the auditors cannot obtain enough information. Oops. This is the evidence. The auditor cannot obtain enough evidence to form an opinion. I'll tell you a wacky one. here's a wacky time that you can add the disclaimer of an opinion. If the auditors are found to be in violation of the independence rules, if you're in violation of the independence rules, I don't think I talked about this before. This will also be a disclaimer of an opinion. So you do an audit, you get to the end of the audit, or maybe even the audit's over, and you find out that there's a independence violation. Maybe someone has a close relative that works, the upper management. Maybe you have someone who owns stock in the company, whatever it is. So you get done with the audit, and assuming that you can't, it's not something that can be easily changed. What I mean by that is, suppose someone bought stock in IBM after year end, but all the work up before that was done before. Maybe you could do the year end work of that individual. Someone else who's independent could do that work. But let's say it's not fixable like that. Not that you have to issue a disclaimer of an opinion. And the reasoning behind it is that you don't have the independent evidence to support an opinion. It's not independent. So any evidence that you gathered is not independent. So disclaimer of an opinion. They could ask this on the CPA exam. I'm sure that's where I got it from, was a CPA review. But if the auditors are found to be in violation of independence rules, a disclaimer of an opinion must be issued. They cannot issue any other opinion. Okay, which of the following types of misstatements result in a qualified opinion? Qualified is, everything's okay except for this one thing. Adverse opinion, material and many accounts. And the disclaimer of an opinion is, we don't know. They might be perfectly fine. They might not be. It's unknown. Okay, scope limitations. I think we talked about these also. As long as it is this thing. Hey, we're almost there. 4 easy little questions. So scope limitations, that are limitations on the evidence that can be obtained. So limitations on evidence that can be, so whatever it is, they can't get the evidence they need. And which type of limitation is considered the most serious? You want to try for that one? I know I've been talking all the time here. The one that's going to be the most serious, oh geez, yeah, so C, a scope limitation that is imposed by the client. This is going to be the one that's the most serious, and the reason is it's the client actually actively trying to keep you from getting information that you need. These other ones are, things happen, whatever. They had a fire, destroyed their accounting records. It isn't that they didn't want you to see those accounting records, but they had a fire, and auditors are hired after year end. The auditor they first hired left the country or did whatever, and they had to get one in later. That is beyond their control. So these first are beyond their control. The scope limitations imposed by the client are the most serious ones, because it's sort of like if somebody is not letting you see something, that's what you want to see. So I have a murder investigation, and I say, yeah, you can investigate, but don't look at my car. Well, you want to look at my car because, if I say you can't look at my car, that's the first place you want to look. And it's the same thing with the client pose. So this one, if the client says you can't talk to my lawyer, well, now you really want to talk to the lawyer. You wanted to talk to the lawyer before, but now you really want to talk to the lawyer. So these are the more serious of those. A scope limitation that is deemed possibly material and pervasive should have which type of opinion? Again, if it's scope limitation, you don't know which one it is. If you say, well, why don't you give it an adverse opinion? An adverse opinion is only for those things that are known. So it's not going to be these two. These are for known dollar amounts. And the disclaimer is when you don't know the dollar amount. So you can't give them one of these. So they say, okay, this might be, this could be material. Okay. A scope limitation that is possibly material but not pervasive should have which type of audit opinion? I should say could. There's actually two of them on here. So it's possibly material, but it's not pervasive. So what other one do we have for not pervasive? So we could certainly give them a disclaimer. But there's one type of audit opinion we may want to consider giving them. Oh, I don't know. Yeah, it is weird that the chat isn't coming up on the side. These are all private, yeah. I don't know why this is doing that. The other type of opinion we can get is this. I don't know why the chat isn't showing. Give me 1 second. Do I have it? I don't know why. I apologize. Okay, so a qualified opinion is an except for. So what do you do in that situation? You just say, okay, it's possibly material. Let's assume it is material, but not pervasive. And you would issue a report saying, look, we can't confirm, whatever this is. We can't confirm these accounts receivable or whatever. But even if these should be all misstated, it's not pervasive, and the rest of the financial statements can be relied upon. And this gives some assurance. So you don't want to, if you can give some assurance to the people reading the financial statements, that's what you want to do. Some assurance. A disclaimer is like getting nothing, no assurance, anything. No, here's a disclaimer: nothing. We don't know. It's like shrugging your shoulders. So qualified would have some assurance, and they say, okay, we can't figure out these accounts receivable, but the rest of it, the inventory's fine, the equipment's fine, the land's fine, the accounts payable's fine. You might want to give a qualified opinion. A qualified opinion is sort of like the second best on here, because it says everything, there is a problem, but these can be relied upon. So this is like the second best opinion. If you can give that, you should. It helps your client, and it'll help anyone reading the financial statements. Okay. A scope opinion that is limitation is deemed to be not material and not pervasive. So it's not material, not pervasive. Is a scope limitation, but clean opinion. Yeah, I mean, if it's not material and it's not pervasive, even if it was pervasive, if it was not material. If it's not material, right there, okay, it's going to be, oops. So if it's not material, standard unmodified. Hey, it's the end of class. So this is the last thing we're going to do. I will send out the back up here for a second and see these. I will email out the exams in a little while. What did I do? Did I answer the first one? No, I did. I didn't highlight it. Okay. And so I will be sending out the exams probably later on tonight. I want to check and make sure they got everything I want on there. And they're going to be over the 3 chapters. Probably a couple questions out of each of them. Maybe a little bit more out of the chapter 7, the internal control one, just because we spent more time on that chapter. Well, and it's a bigger subject. So later on, I will send out the do this. Certainly by, let's say, 8 o'clock tonight, I should have this out. And it's due by 5/3. And remember, everything can be turned in up until 5/6/24. Need a screenshot. I'm going to write my document. No, I won't. Because I don't know. Well, no, no one can see it now. You can't see it. Okay. I'm making a funny face in there. Okay, any questions? Hey, great having you guys. And I will have that out there by, let's say by 8 o'clock. I should have should send you guys the last exam. It's the last thing we're going to cover. Next week, class, you're welcome to come. It's optional. It's only for tutoring or people want to clean up stuff. There's no new material. Any questions? All right. Hey, a little bit early. I'll talk to you guys. Hopefully, see you later. What happened here?